Everybody, and happy Thursday. We'll get started in just 2 minutes. Good morning. If you guys have any questions before we get started that I might be able to get to later, please let me know so I can make a note of them. We've got quite a few things to go through here this morning. As you can imagine, we've got obviously had a sell-off data yesterday, let's just put it that way. So we want to make sure that we go through all that properly. All right. All right. Again, good morning, everybody. We'll get started in just a minute. If you're new here today, please make sure you subscribe to our channel. It's very important, both for you and for us. Obviously for you, you get the updates in real time when we go live with our live analysis. And B, of course, for us, because it allows us to continue to be able to do this morning show. So we are, I think, ready to go here. It's 2 minutes past the top of the hour. So let's get started again. For any of you guys that are new here today, welcome. This is I'm Berger from the Steady Trader. This is our Set the Market morning show. 10-15 minutes is what we do. We go through the most important things. And I had several phone calls last night and a breakfast meeting this morning with a group of investors, and we talked about yesterday. And so I would like to share with you what we are seeing here. So first of all, let me just, as I've done for the past number of days, let me give you a quick update on where we are as far as that micro seasonality goes that we have been talking about now endlessly and tirelessly for the past week and a half. So again, just to kind of set the picture in case you haven't seen this before, all this is, it's very, very simple. It's the white line is 30 years of seasonality for the S&P 500 since from October to the end of the year. And we've been talking about this now since January 5th or 6th, I think, that the market is likely going to go through a digestion period, consolidation, a little bit of a pullback, what have you. Obviously, that's happening. Yesterday, I think, was, in case anyone wasn't aware of that before, they should certainly be aware of it now after yesterday. And so, historically, these consolidation phases have ended on the 20th or thereabouts of December. Now, what's interesting is that after that, of course, you get the year-end rally. So, again, this doesn't have to happen. We still think it is very likely to happen, but let me give you a little bit of context as well. So basically what the Fed did yesterday, which by various points of analysis that I found has never done before, it cut rates yet warned that inflation is going to go up. Now, as you guys know, hopefully we've talked about the higher inflation for longer theme. That's a big deal, the higher inflation for longer theme. And the Fed is now basically, we've mentioned it to our clients, Inner Circle members. I told you, I think almost a month ago now at this point, maybe a bit less, maybe about three weeks ago, that the Fed essentially admitted that inflation shocks are higher. And now yesterday they made it even more official, right? Now the market doesn't like that. Why doesn't the market like that? Why doesn't the stock market like that? There's multiple reasons for that. And so let me walk you through this. We'll just look at a chart here to keep it very simple. So the equity market doesn't like this because the near-term risk shocks that we tend to have nowadays are very severe. Why? That's kind of a dumb thing to say. The risk shocks nowadays are very severe because we have these very near-dated options, like expirations. As you guys know, and I've been critical, and I'm going to continue to be critical of these because they can cause big problems in the market. Yesterday was the second largest one-day increase in the VIX. It was 74 or 75%. Now, again, notice that this does not mean that this is the end of the world and this the end, but it's a problem for portfolios where people are taking too much risk, right? And so just kind of keep that in mind. Nevertheless, we actually think that it's probably a buying opportunity, very near-term tactical. And then here's how we're looking to measure this. So then I'm pretty sure this is the only thing people care about. So let's just get to it. Let me just get right to it. Okay. So as far as the S&P goes, I still think we have the seasonality here potentially into year end, right? There's just too much, things are going to slow down here basically as of today. People are filing out. I mean, the amount of cars I already saw this morning leaving the city is insane, or even yesterday. So it's just like people are just filing out. That doesn't mean that things can't happen, but it means less people are going to participate, and that typically then leads to sort of more of a buying market. What I could see happening here is, because we reached that $6,100 mark for the most, 6,100 area for the S&P, I should say, for the most part. I still think 6,200 would have been possible. I'm not so sure. I think it's less likely now after yesterday's move. What I'd like to see is whether we make new highs or we make lower highs now. That's really the key on this next potential move higher, right? And that move higher doesn't have to start from today. I could easily see another, couple % of downside. But here's what I want to prepare for. Whenever we do get a reversal for another bounce, we'll get it even if the market falls 20% from here. At some point, there's a bounce, right? And obviously, I'm not calling for a 20% drop, but we're going to need to watch it very closely, because the reversal tends to happen very quickly here this time of year. You get one chance at it, basically. You don't really have much more than one shot, and because we're on the clock here, and it's like we're in the ninth inning, sort of near the bottom of the inning. So we want to watch very closely when that happens. If it happens, I still want to make sure to be clear. Obviously, nothing's 100% sure, but it's going to be very important to see if the market makes higher highs or lower highs. And I'm just trying to play multiple scenarios because, again, as a risk manager and portfolio manager, whether it's for other people or for your own money, you want to make sure you have multiple scenarios mapped out. So in case we make a lower high into next year, it is possible that it is the top of the bull market. That is entirely possible. Is that my call right now? No, but it's a possibility, right? If we make a lower high. If we continue to make a higher high at some point early part next year, then we continue. But I don't want to discount the fact that everyone's bullish. We know that everyone has the same narrative. U.S. growing at a nice clip. Rates are. We'll get to rates in a minute. Actually, rates are dollar strong. Rates are strong, right? So you don't have a situation. Rates are strong because, the economy is holding up, right? So you don't have a situation. So what we're going to have at some point is whatever happens, and just this is an important thing, whatever ends up happening to derail this, whenever it happens, right? And it's not my call, right? It's going to be something that basically no one expects. So you have to think about those. So all the analysts right there that are telling you they're wonderful year-end shiny targets for the S&P for next year, which is a completely useless thing to know. They might as well not do it, but they do it because everyone else is doing it. But it's one of the most useless things to listen to, because what it does, it gets you mindset on some magical unicorn target that they never reach, and if they do, it's complete luck, right? No one has the kind of foresight. It's complete BS. But we want to be open-minded to things, and that's really why we're calling this 2025 the year of the trader, because things are going to get more volatile. I'm not calling for VIX 100 and things to fall apart. That's not the point. I'm calling for more volatility, which creates more opportunity for people who know how to trade. I think very few people know how to trade anymore. People blindly buy dips. I keep saying that's not trading. That's buy and hope, right? And that's ultimately fails spectacularly to the point where people give up years of profits. I know no one cares to hear that, and some people get angry, but that is how it plays out 10 out of 10 times once it happens. I don't know when that happens. So we've talked about the VIX. We've given you a seasonality update, so that's two things. I've talked about the potential of, or what we need to watch for potential lower highs. Let's talk about rates. That's the one thing we haven't talked about, and quite frankly, it's the most important thing. So rates. So on 10-year yields, I made a video yesterday. You guys go check it out here on the YouTube channel. And I argued that, for me, the levels to watch as far as 10-year yields go, and let me get rid of these lines. They are really totally useless. Essentially what I'm looking for is on the 10-year is if we break 3.3 in the downside, the stock market's not going to like that. And certainly if we break and hold above 5, that'll be a problem for the market too. What we had yesterday was more of a volatility shock on a one-day basis. I actually don't think it's going to last very long because, again, seasonality is just too strong. The Fed did kind of mess up yesterday, and it's not for me to be critical. Gosh, I God know I wouldn't want to have their job, but they did confuse the market, and that's the real problem with what's happening. So what's our forecast for rates? I want to be short TLT or long TBT. We're actually, if you're an Inner Circle member, you're receiving a trade alert this morning around those parameters. You'll see it when you get it. So I actually think the next stop here for 10-year yields is probably going to be the next lower highs. So you have these are very simple numbers to go. I mean, this is kindergarten stuff, right? Like anyone can do this, but I do think these are the reasonable levels to look for now. So the next level would be 4.775, whatever, something like that. And then after that, probably 4.9, let's call it 5, right? So I think these are reachable levels. I'm gonna say let's go with 4.7, 4.75 first. And again, that's higher. So if you're looking at this from a charting perspective, which I always caution that looking at rates by just drawing a line and not understanding the why or what is dangerous. But I do think that's going to be the next higher. So if you're asking, what about, what does that mean for your TLT position, which I hope no one has any TLT anymore or not in meaningful size because it's this stuff is probably not going to act very well. Well, TLT should probably go lower. So if you are using the TST trender, which we talked about yesterday extensively here this morning in the morning show, just notice that TLT gave us a new sell signal a few days ago. And that's this one right there you see on your screen. And I know I have this all messed up here because I've got a weird thing. So we got a new sell signal in TLT a few days ago. Obviously, that's working. Now, the inverse of that would be TBT. If you want to be long something, one would want to own TBT. So that would be this. And here, too, we got a new momentum buy signal a couple of days ago on TBT. So what I'm trying to show you here is, A, understanding the macro picture. I'm looking at the wrong camera. We need to understand the macro picture. Then we need to understand the structural picture, and then we can look at charts, right? It's all three combined. Because I think if we don't, we want to be very data driven, but it makes it easier, I have found, to respect the data if I can get my head around what's happening. I'm not going to understand it every single time, but I sure as hell want to try because it allows me to risk manage better. Does that make sense? Does anyone have any questions, or is this all clear? Everyone made money yesterday because you guys are all long put options and no one owns any NVIDIA. Obviously, notice my sarcasm there. Or maybe you've tuned out for the year. But if you have any questions, please let me know. I just want to go through these important points here this morning. So again, our call is here. We do think yesterday was a meaningful day, and we will continue to respect this, 100%. But also, we do think that this is a day that we want to continue to watch, not just on a one-day basis. We do want to look back and see if this ultimately leads to lower highs. So that's kind of what we are looking for. And the last point, again, just back to the volatility point, the reason we're having these big moves, again, yesterday's down day, I don't know the last time we had a 3% down day in the S&P. Maybe someone can go look at that. It's been a while. The reason it's happening is because of all the short-dated volatility options trading. And again, I realize a lot of people do that, and that's fine. I think people are not aware of the risks that that can cause, right? Today was just an example. I'm gonna say yes, it was a warning shot that people need to be cognizant of those facts. That these short-dated volatility options strategies, whether it's buying or selling options, can be very, very tricky. So anyway, that's what I have to cover here, folks. I hope it was helpful. Please subscribe to the channel, give us a thumbs up, like, and we'll see you guys back here. Actually, hold on, there's a couple more questions. Let's see here. You think January tax selling effect will... I don't know if the January tax selling effect will take place. I suspect it might. What I will tell you, main man, is that again, I just gave you my playbook here. I want to see if whatever the next bounce is goes to lower highs or not. What your question implies some sort of crystal ball. If you look for crystal balls, I'm sure on Twitter someone will give you their crystal ball. I'm sure on CNBC they will, and this is nothing against those two institutions. I like both of them. We're here dealing with reality, right? In reality, you do have to kind of go through this in real time. So I'm trying to give you my roadmap here of what we're going to look for. Making a forecast like that's very difficult. Whether we can see the January tax law selling, I still think it's not going to happen this year because there's too many people sitting on too many gains, right? But I did make a video on that, or I think I even mentioned it in one of these morning things here about that it's more likely to happen in January than now. But again, we'll find out. Listen, if the S&P makes a lower high, we will find out. So that's hopefully it helps B-Men. Again, thank you all for being here. This is the last Set the Market morning show for this week. We will be back and do one last one for the year on the 30th of December. So that is a week from this coming Monday. We'll get at it one more time, and then we'll be back in the new year starting on January 6th. In the meantime, any questions, please let us know. Please subscribe to the channel. Very important so you get updated in real time when we do these shows. Also, it allows us to continue to do this. Thumbs up, like, have a great weekend, and good luck out there.